is important because when we talk about actively and passively managed funds, this is what we're talking about. Because this approach to investing doesn't require nearly as much hands-on intervention from people trying to beat the market or trying to predict the market, even though it's been proven to be statistically impossible, it is significantly less expensive. And I'll also say this because I know how some people are listening to what we're saying about it being less expensive. Don't think about this the same way you would a cheap product.
Right.
Cheaper in this case is actually a good thing, not a bad thing. And because Vanguard is obsessed with keeping their costs low, you'll often hear people complain about things like their website being clunky and not as fancy or slick as some of the other competitors who have flashy apps and notifications and social networks. Well, the reason for that is because they believe the quality of their fund performance speaks for itself, and they want you to keep and invest as much money as humanly possible. Welcome to the Rich and Regular podcast presented by Success, where we explore life at the intersection of money. I'm Kirsten.
And I'm Julian. On this episode, we're talking about total stock market index funds.
Ooh, riveting.
It is.
Can't wait.
It is. The inner financial nerd in me is very excited about this conversation for so many reasons that we will get into later. But one I will share now is that I'm going to step out on a limb here and say that this podcast episode is going to fundamentally change someone's perspective on investing.
Ooh, okay. Now we're cooking with grease. You're not easily excited, so...
This is my excited voice. Super chill.
Right.
It's about as excited as it gets.
Well, before I ask you why you're so excited, I want to remind our faithful listeners that we are almost at 100 ratings and reviews on Apple Podcasts, and we would love your support to get there, especially if your life is in fact changed by this episode.
Listen, if your life is changed and you don't leave, the absolute least you could do is leave a rating. We'd very much appreciate it.
Okay, so now what makes you so confident about this episode?
Well, now I'm questioning it. But no, listen, I can remember very clearly the moments in my life that have shaped and there have been several, but the moments that have shaped my investment philosophy, and many of them are like tied to gaining clarity around the power of index fund investing. And I know we've spoken about this in depth and casually in the past. But as I was thinking about it in preparation for this conversation, I also realized that there were two categories of these types of moments. And so there are the moments around index fund investing that I think are private moments. Like you're at home, you're reading a book, maybe you're just watching something and there's no one else around, or maybe it's just you and your partner, it doesn't matter. It's a private moment. You have a brief exchange, you pat each other on the back, or you have an in-depth conversation. Great. But then there are those moments where this little private idea or belief that you have is validated in the mainstream media, which kind of goes back to what we were saying before. Like the media really shapes the way a lot of us think. And so you could have found an idea or found a community and it's yours. You just keep it to yourself. You don't share it with anyone else. But the moment you see it on television, it's like, oh, wow, this is really a thing. I'm a part of something bigger, a revolution, if you will. And I would argue that index fund investing has very much been a quiet and massive revolution. If you're in the personal finance space, the personal finance media space, for sure, you understand this. If you're not, which I would imagine most of our listeners aren't, you may not understand that. And so, for example, I remember when John Oliver on Last Week Tonight, you know John Oliver.
Oh, yeah, I love his little angry self.
Yeah, it's a little, he's a lot. It's a lot.
But it's all in an accent, so that just makes it easier.
It is. It's a little more tolerable, but after a while, it's like, all right, I get it. But I remember when he finally did like an epic takedown of the financial services industry. It was absolutely brilliant. And I remember thinking like, yo, this is going to really like, help spread the word. And, it is what it is. Because at the end of the day, there's like his audience, and then there's the massive marketing budget of financial firms and them communicating different messages to people. Similarly, I remember when the film Playing with Fire came out, which is a documentary that we just happened to be in for a solid 15 seconds.
About 18 seconds.
But we're 18. You're right. I want to shave
we dropped
anything
some
off.
bars.
But we were in there, and that's not shade. That's just a little running joke that we have. So shout out to our friends, Scott and Taylor, for including us in that project. But I remember when that film was released, it was like, wow, like we're in a movie, like an actual movie. And it's a good one about this movement. And obviously there is a role that index funds and total stock market index funds play a role in that. And so all of that to say, like, this conversation, I think, for someone may do that. And it's helpful to kind of have a trusted voice to be able to say, like, this is why we do this thing. This is why we believe so passionately in it. And, it sort of owns space, I think, in the hearts and minds of people. So hopefully we can do that today.
Yeah. And since it's still Women's History Month, selfishly, my hopes for this episode is that it causes a little confidence bubble to come up in women. That sounds like you're about to burp, but I mean that in a very positive
way. I was like, yeah, I don't know. I mean
that in a positive way. But it's because I've done a couple of talks this month, and the stats around women's financial confidence are heartbreaking.
Yeah.
We know that there's a gendered financial literacy gap, meaning men are more financially literate than women. But 1/3 of that gap is attributed to a lack of confidence.
Yeah.
Women actually know more than they think they do, but the confidence gap is the thing that makes us less likely to invest in the stock market and make financial plans for the future. So I'm hoping that we're able to explain this in a way that makes women stand up a little taller and burp confidence.
Yeah. But,
Sorry.
Thank you.
I almost nailed that,
Ladies,
but
please
I'm
don't.
a little awkward.
Yeah. Okay. So I wanna back up a little bit and talk about why we're actually talking about this now. Like, we're not talking about it just because it's Women's History Month. We're talking about it for another reason. And so basically, when you invest in index funds, which are a form of mutual funds, and maybe I should back up there too. So mutual funds, just a quick little Julian definition here. And so there are stocks, which are basically publicly traded companies. Whenever you gather a collection of those stocks and you, bundle them up together, those are called mutual funds. The idea is that you're not over-invested in any one stock or maybe even any one sector. Obviously, you can do that, but the idea is that you're not dealing with just the ups and downs of any one particular stock. You're spreading that out so that you have a wider collection of it to minimize risk and to help diversify the fund. Yep. A type of mutual fund is what index funds are. So mutual funds, for the most part, are designed to beat the average being, it could be like the Dow Jones Industrial Average or S&P 500 or something like that. There are funds that are designed to do other things, but by and large, that's what they are supposed to do. Index funds are different in the way that they're not trying to beat it at all. Like, they're just trying to track whatever the average is. So if the total stock market is up, they're trying to be up at the same degree, same thing, vice versa. Fast rewind to 1929, brief little history lesson, right around the Great Depression, or right after that, because it was such a horrific economic event, the SEC released new regulations that basically forced companies to share reports that said, hey, this is actually what's inside what you're investing. It's kind of crazy to think that that didn't exist before. But after that, this is sort of why we are where we are now. And so because we invest in mutual funds, predominantly index funds, we receive an annual report that basically says, hey, this is what's happening inside the fund. This is what implications it may have on your financial life and so on. It's no different than like a company. If you work for a publicly traded company, they are forced to create an annual report. The same thing happens with these particular funds. And so this year, we received several annual reports because we have several funds, but there were two that I was especially excited about. The first one is the Vanguard Total Stock Market Index Fund. The ticker symbol is VTSAX, very popular fund. And the second one was the Charles Schwab Total Stock Market Index Fund. We also invest in that in a different account. They are essentially the same thing. I'm sure there are minor differences between the two. But I was excited because this year was the first year, it's 2022, that I can say like, wow, I've actually been invested in these funds for 10 years. Because typically when you're looking at these reports, they look back 10 years, you can see this is what happened from 2012 to 2022 or 2021. And now it's like, oh, wow. Like, because normally I'm like starting in the middle.
Oh, you have to shave off some years.
Oh, yeah.
It's
or,
like, okay,
or
if
I'm
that
imagining.
was the 10-year, yeah.
Yeah, like you look at like where it was, it's typically lower before. And it's like, wow, man, well, what does it feel like to have been there? And I was like, oh, wow. And I'm there. And next year is going to be like, wow, I'm off the page.
Yeah.
They're not even talking about the prior decade. And so it just kind of felt like, I'd grown up a little bit.
Yeah, these are the positive aging milestones that we need to be talking about. That is actually a nice benefit. But I think there's something to what you're describing with the difference between being a long-term investor in theory and being a long-term investor in practice.
Yes.
Because it changes your relationship with money and your level of understanding and comfort, especially if you look at the data around women, where 9 out of 10, 90% of women plan to take steps within the next 12 months to make their money grow, but only a third of women see themselves as investors.
Yeah.
They're confident being the CFO of the household and managing day-to-day finances, but less confident when it comes to long-term planning and investing. Yeah. So this ability to see how your money has performed over a long period of time can be a really powerful nudge in the right direction for a lot of people.
It absolutely is, right? Like you have so much more confidence
because
you can look back on a whole decade, and I can say I've been through a couple of recessions. We've been through fingers crossed, is hopefully the end of a pandemic. But like we've been through like economic rebounds and all of those things. And so after a while, it's almost like your sea legs are under you, or like being on a roller coaster where you just feel like you don't feel that sinking pit in your stomach anymore because you're just been through it, been there, got the T-shirt and the hat. And so that's kind of how I feel about it. So this 22 report kind of felt like, receiving it almost felt like I was receiving like a diploma. It was like, congratulations, you've survived an entire decade of ups and downs, and you have been handsomely rewarded. Go on and be great.
All right, so let's break down what's in the annual report. And we're only going to focus on the Vanguard Total Stock Market Fund, again, because it's a pretty popular fund. And like Julian mentioned, there aren't many differences between it and the Schwab Fund. So first things first, there is a lot in the annual report. The 2022 report is just under 100 pages long, and I don't expect any of you to actually read it. So I'm going to give you an overview of what's inside. There are 4 key parts, which are 1, the fund's performance. It's typically the rate of return at a few key points in time. So 1 year, 3 years, 5 years, 10 years, et cetera. Then there's the fund's expense, which is how much it costs to invest in it and how much you can actually expect to pay over the life of holding it. The third thing is a performance summary. This is usually a more specific breakdown of how the fund has performed. So it'll include the different versions of the fund, institutional shares, admirable shares, et cetera. And then lastly, there's the financial statements, which tell us how much of the total fund's holdings are in specific companies.
Yep.
We are not going to go through all of the details because that would take forever, but we can start by just kicking off about what the fund performance is.
Okay, so if you just had 2 minutes to scan this annual report, this is probably what you should be looking at. And basically it says that for the 12 months ending December 31st, 2021, VTSAX's return was between 25.59 and 25.75%. Wow. The only difference is that there are investor shares, which is what we own as investors that are purchasing funds directly from Vanguard, compared to like institutional shares, which is like a set of shares that you would be issued if you were purchasing through like an employee-sponsored fund. So, for example, the way that I think about it is like Microsoft Office, for example. You can go... I don't even know how people, you just download it. You can go straight to Microsoft right now. I was about to say you can go to Best Buy. You probably can go to Best Buy.
You can.
What do you get? A USB?
A disc.
A disc? Wow. That sounds crazy. But you could buy like straight off the shelf or download directly from Microsoft. Or through your employer, you may have like a company issue laptop and you're going to get a version of Microsoft Office there, right? Or if you're a student, I remember back in the day, they probably still do this. You may have like a student edition. So it's the same thing, same underlying software. And this is a very similar thing with Vanguard index funds. So VTSAX, the Total Stock Market Index Fund, there is an institutional version of that, which is a VTSX. And so if you're trying to invest in that fund and that's what you see in your employee-sponsored plan, this is actually the fund that you would be buying. It's the exact same thing. Think about it like Microsoft Office or like Zoom or something like that. Same thing. So 25.59%. Let's just go ahead and call it 25 and call it even, which is amazing. And we'll talk about that a little later. The second thing that you will see in the fund performance section is what's driving that growth. So I'm going to pivot here and use like a sports reference because I just watched the Brooklyn Nets this weekend. If the Nets were having a great year, which they're not, but if they were having a great year, an analyst might say, wow, they're having a great year behind Kevin Durant, who's really stepped it up, or behind Kyrie Irving, who clearly is only playing road games for whatever reason. But the point is, you want to know, like, what is leading that performance. And sometimes it could be what's happening within the fund or continuing with the sports reference, what's happening within the team, or it could be like outside of the team. Like actually they're really only crushing it because everybody in their division is hurt or playing horribly. And as a result, like their average play is sort of seen as really great play, which is sometimes happens. But in this case, when we're looking at the fund, you want to look at the sectors, which are the components of the fund that may be outperforming and driving growth. And in this case, there are 11 sectors within that fund, and all of them recorded positive returns for 2021. And so whether it's tech or financial, consumer, discretionary, stocks, or sectors, all of it basically was performing well. And so given the fact that VTSAX is a fund that is aimed at following the rate of return of the overall stock market, if all of the underlying sectors did well, then the fund did well as well, which I thought was really, really cool. I will say there's a bit of a downside, and this might be a sore spot for some people, but this is sort of where inflation comes in. The performance at a glance section of the report also covers very briefly CPI, which is an acronym for the Consumer Price Index. And the reason they do that is because you want to know, like, also how well the fund is doing relative to the general cost of goods and services. So think about it this way. If you had $0 last year and you had $100,000 this year, you're super excited. You've got way more money than you had before, and that's great. But if the general cost of like owning a home or buying a car or just living your life in general like tripled over that time, you're probably not as excited about that $100,000. So you want to look at it relative to what you can actually do with that money. And in this case, CPI was up as well, right? So you've probably heard on the news, we're living through a hyper inflation environment, and that's also reflected and documented in this section. So if you're interested, you can dig into obviously the growth, but they get into a little bit about consumer price index as well.
Yeah. I think the bright side is that, again, compared to a standard savings account, which average around 0.5% in growth in most cases, 25% is still better, even if it has a higher CPI.
I heard someone say a joke the other day that savings accounts rates looks like blood alcohol levels.
Yeah.
Like it's ridiculous.
Yeah.
Sorry, bad joke for anyone that is sensitive to that. My apologies.
But in general, stocks are a good long-term asset class to hedge against inflation. Some are better than others, to your point. But if you're investing in an index fund, it likely contains companies that have pricing power. And as consumer prices increase, so does the value of the stock.
Yeah.
And so it's kind of this game of everything being connected and you having to do some ratios and math to figure out what your true gains are.
Yeah, I mean, the last thing I'll say is it is a bit of a motivation or a different way of thinking about the importance of investing, especially today, right? Like it's one thing to have cash and to have comfort in having cash or holding cash in a savings account, but in this kind of environment, you're actually losing money every
Correct.
single day that you do that. So you
Yep.
really want to, without the possibility that it might rebound
Exactly.
or increase.
Yeah.
Okay, so the second part, let's move on. The second part of the annual report is looking at the fund's expense. So we're actually not going to spend too much time on this because very early on, shout out to our early listeners, we did an entire episode on the cost of funds. I believe it was the second episode of the Rich and Regular podcast. So go back and listen to that if you want to learn more about expense ratios. But here are the highlights from the report. And actually, I'll just define it really quickly. So an expense ratio is a term used to describe the cost of owning a mutual fund, or in this case, an index fund. And I'll just read directly from the report so you can see how Vanguard describes it. They basically say, quote, as a shareholder of the fund, you incur ongoing costs, which include costs for portfolio management, administrative services, and shareholder reports like this one, among others. Operating expenses, which are deducted from a fund's gross income, directly reduce the investment return of the fund. So they're basically saying, hey, it costs money to do this for you. We've got to pay people. We've got people who support those people. And we have to issue this report, which costs money.
Yeah.
And so we're passing that on to you. That is the cost of operating this fund. We take it off the top, which, again,
Yeah.
that always
benefit.
Right. Like, it's not like you get a receipt. It's not like they're going to show you and say, hey, here's how much it costs.
Right.
No, they just take it off the top.
Yeah.
And what you actually see, how your return is calculated, is basically net operating expenses.
Exactly.
Yeah. And then they go on and give you like a hypothetical example of what that might look like.
Yeah. So they give you an example of how much you might spend if you bought a fund broken down by the type of shares that you own.
Right.
And you're probably going to laugh at how ridiculously low this is.
I do.
So, for
I
example,
knew it was low, but I was like, wow.
Yeah. So, for example, we own what's called Admiral shares, which is a special class of funds from their base level, and they give you a discount based on the amount that you invest with them, which is at least $50,000. So, if you had a beginning account value of $1,000 on June 30th, 2021, by the end of the year, your ending balance would have been $1,090.90. And the amount Vanguard would have charged you would have been a whopping 21 cents, which, again, they would have taken off the top. Now, if you had owned...
Don't even feel right saying it. They claim their 21
took their
cents.
21 cents. Now, if you had owned their lowest class of shares, it would have cost you 74 cents.
Three times as much.
Yes, 3/4. Because, again, they give you a discount if you buy more, right? And if you would have owned their highest class of shares, which is institutional select, that $1,000 investment would have cost you a nickel.
Yeah.
A nickel. Like, I have
last
lost
time you saw a
nickels.
nickel?
I know. I saw one in Bo's piggy bank. Not
Yeah, I
too
was like,
long
oh,
ago.
look at that. Who's on a nickel?
Isn't it Jefferson?
Nah.
I don't know.
Jefferson's on the penny.
Gosh, I don't.
I legit do not know.
I don't know.
If you listen,
Don't leave that in
if you
our
listen
review.
to this,
They're not experts. They don't
tweet
even know
us.
who's
They
on a
don't
nickel.
know who's on a nickel. Pop quiz. I can't. I'm looking at it. I know the face.
Yeah.
Maybe it is Jefferson. I don't know.
I
Anyway,
think it is. But anyway, this is important because when we talk about actively and passively managed funds, this is what we're talking about. Because this approach to investing doesn't require nearly as much hands-on intervention from people trying to beat the market or trying to predict the market, even though it's been proven to be statistically impossible, it is significantly less expensive. And I'll also say this because I know how some people are listening to what we're saying about it being less expensive. Don't think about this the same way you would a cheap product.
right.
Cheaper in this case is actually a good thing,
Right.
not a bad thing. And because Vanguard is obsessed with keeping their costs low, you'll often hear people complain about things like their website being clunky and not as fancy or slick as some of the other competitors who have flashy apps and notifications and social networks. Well, the reason for that is because they believe the quality of their fund performance speaks for itself, and they want you to keep and invest as much money as humanly possible.
And I don't know that I can disagree with them, right? Like they are truly an interesting company, and there's so much that we could say about them. We're not caping for them. This is not a paid ad for them.
Yeah, we invest outside of Vanguard
We invest
too.
outside, right? But we definitely are proud to be a part and kind of like aligned with the values that the company has. And so that's part of the reason why we're really excited about them. And by the way, we don't just invest in VTSAX. We have several other funds as well. I Googled it. It is Thomas Jefferson.
I told
actually
you.
on the nickel.
See?
So you were right. We may just ask our podcast producer to edit that out.
Nope. Leave it in. Women are confident in their money. They just don't think they are.
Yeah. But no, I love your point about cheaper not necessarily being less than in this case, because that's really important. Like the less that you're spending, the reason why they're doing that is because it gives you even more of an opportunity to reinvest any of the gains back into the fund, which adds to what can compound and just essentially result in a higher rate of return for you as an investor. It is wild to think about how cheap it is, like cents, literal pennies on the dollar, like
to make $100.
Yeah,
almost.
Yeah, and that is the thing that makes, in part, index fund investing such a powerful approach. Because I think it takes some time for people. Going back to why I thought this particular podcast would help someone. It takes time for people to wrap their head around that. I think we are trained to believe that expertise and sizzle and all of those things are really what are going to make one fund or going with one company far more successful. But in this case, it's been statistically proven that managing cost, the thing you actually can control, is one of the best ways to actually build wealth. And so it's the power of frugality through investing perspective. So I hope somebody's light bulbs are going off about this. If so, we're going to give you a little break to think about this, or maybe do some quick Googling while we take a quick break for an ad.
All right. So far, we've covered fund performance, which again shows how the fund is doing and what's driving its growth or decline in some cases. And we've covered expense ratios, or the cost that you'll pay to have the brokerage hold your assets. The third part we're going to talk about today is the performance summary, which is where funds get into a few more details.
Yep. So in short, the fund itself is designed to mirror the stock market, as I've said, right? So whatever the total stock market is doing, its job is to reflect that in your portfolio. And so in 2021, the total stock market returned 25.72%, and VTSAX was right there at 25.59%, like a negligible amount between the two. It's just trying to follow it. And the same was true for the 5 and the 10-year average as well. So over the last 5 years, the market has returned an average of 18%, and VTSAX gave 17.86. When you look back on 10 years, which is when I started investing in this particular fund, the average was 16.31%, and VTSAX gave 16.16%. So let's use an example to give that some context. If you'd invested $10,000 in 2012, which we actually invested more than that, but assuming we had just invested $10,000, that and made no other contributions, that $10,000 investment would be worth $44,743 by December 31st, 2021.
Wow.
So basically, let's just call it four and a half, right? Which is really, really cool. And I'm grateful for that, especially when you consider the fact that it costs us essentially pennies to do that.
4.5 times.
Four and a half times the original value, 4.5 times the original contribution of $10,000. I think another way to think about this is looking at the actual rate of return, which was 16.16, and then looking at what the average historical return for the stock market has been. If you just did a quick little Google search, you're probably going to see that it says 10%. You may also see 7%. I'm going to go ahead and say 7% because we're adjusting for inflation, which I think is particularly relevant and given the times that we're in. But even when you look at it from that standpoint, we're saying, all right, 16.31% is like over twice the historical average, right? So basically, not only is the stock market producing incredible returns compared to its historical average, your general cost of investing in a simple index fund like VTSAX or other comparable funds would be something like just a few bucks, like a few dollars to do that, which I think is just one of the other reasons why we're such huge fans of investing and recommend that as a foundational aspect of just about anyone's investing portfolio.
Yeah, so two things came to my mind. One was just thinking about the 16% over the last 10 years. It's amazing how many retirement calculators are still using 7 as the baseline for calculating how prepared you are for retirement, which goes to show why you should be looking at these annual reports so that you're using an accurate number.
Yep.
But it's also interesting to me because I've been hanging out with my friends who are still traditionally employed, and I'm remembering how much I used to look forward to this time of the year because it's bonus season at work, it's tax season at home, and you kind of get your annual reviews around this time. So a lot of people are receiving windfall money and their merit increase at the same time. Now, companies like to suggest that merit increases keep up with the cost of living. But almost everybody I know is still getting bumps in the 2% range.
Which is below the rate of inflation.
Which is not keeping up with inflation. So even if we remove this year, which is an anomaly, obviously, but it's still short. 2% still isn't the traditional historical rate of inflation.
To your point, 3% would have been considered high, and even that would not be enough based on what we're seeing in 2021, and certainly not based on what we're seeing this year. I mean, we may have back-to-back years of double-digit rates of inflation.
Absolutely. And so your point of investing $10,000 and letting it sit for a decade is exactly the math that I do in my head whenever I receive windfall money and have to make a decision about what to do with it. One of the smartest things you can do is take a little bit out for a splurge, treat yourself, boo, and then put the rest to work. In the same 10-year period, that money would have 4.5x'd.
Yep.
Even if you doubled your salary over 10 years or tripled it like we did, your investment still outperformed you and didn't have to take on any additional responsibilities, didn't need to manage people, didn't need to experience Zoom fatigue or wake up for early mornings.
Didn't need to hustle.
Did nothing.
Didn't need to do anything. I did absolutely nothing other than ignore the hype. That's the hardest part, ignoring the hype. Don't obsess over anything that you're seeing on social media. Do not try to replicate any of the things that you're seeing besides us. No, but that's the whole point and the value, I think, of being a long-term investor. Sorry, I got excited. Okay, so let's dive into actually one other part of the report that I think is particularly interesting, and that is the fund's allocation. Allocation basically means the components of the fund, and we've spoken about that, but we're going to dive into it a little bit more. And so I haven't used a food reference in a while. Imagine a sweet potato pie. A beautiful, I'm going to say Publix sweet potato pie.
I thought you were going to say a patty pie.
No, it's a little too sweet for me. It's too much. Patty, go at me.
She's a little heavy on the
eggs,
cinnamon and the nutmeg, but it's still delicious.
It's a lot. Imagine a sweet potato pie, right? Or just a pie graph, because it's basically how it's described. But basically, the allocation is an opportunity for you to see what the largest chunks of that pie or that fund are allocated to, especially compared to other chunks. And so when you look at how the fund has evolved, as of December 31st, 2021, the largest pieces of the fund or the pie are in technology stocks, right? So technology stocks were around 29% of the total stock market index fund. So this means about a third of the fund is comprised of companies like Meta, Amazon, Netflix, like all of the big fancy tech stocks that you've heard of. The second largest chunk of the pie is from consumer discretionary brands. So think Home Depot, Nike, McDonald's, cruise lines, Royal Caribbean, all of those things would be included in there. So that's 16%. So already we're just about at half, right? Like just 46% of it is just in tech stocks and consumer discretionary. And then the next two are actually equally weighted. And so you have 12.8% allocated to healthcare companies, and another 12.8% allocated to what are considered industrial. So healthcare companies, you think about the Pfizers, the Johnson & Johnsons of the world. And when you think about industrials, we're talking about companies like Honeywell and General Electric, Old Dominion, if you've ever been on a highway and seen the trucks screaming past you, the freight company, right? So the way I think about it, like those are the companies that make the things that go into the things that make consumer discretionary stocks, right? So, but this is the engine that creates all the goods and services that we actually use in this company to maintain our quality of life. And so just those four sectors is around 70% of the fund. And then the remaining sectors are like financial companies, energy companies, consumer staples, real estate, utilities, telecom, and like just basic materials. And so when you look at that, you start to understand like how widely spread the fund is and why it's such a popular choice, because you get a little bit of everything, and it's weighted in a way that is in favor of whatever is driving the market. I also think it's important because, again, avoiding the hype. There are a lot of people, and I'm not saying there's anything wrong with it, but there are some people who are doubling down on tech stocks. Some people who have maybe half of their entire investment portfolios in tech stocks. Over the last 10 years, if you've done that, you would have done, to be fair, incredibly well, right? But those dips are very different than the dips that you would have with VTSAX. If you can stomach that, more power to you. But if you're not there yet and you want to have much more diverse funds in your growth, this is really the reason why you might want to consider a fund like VTSAX.
Absolutely. And I think the other reason why it's a popular choice, at least for me, is that it makes following the news much easier.
Yes.
Because they're always talking about the Dow Jones Industrial Average and the S&P 500. And when they say it gained 200 points, I know exactly what my account did.
Right.
If it dropped 800 points, I know exactly what my account did.
Right.
Which is different from individual stocks. If I'm watching the news and I learn that my favorite tech stock CEO just sold his Hamptons mansion, I'm not sure what's going to happen with that stock. You don't know how that news is going to be interpreted to all the other shareholders. And so because tech stock CEOs, tech company CEOs, this is a generalization, but are kind of rock stars and celebrities in today's culture, a lot of their personal news and decisions can affect the performance of the stock, both good or bad.
Yeah.
And so it's just something to consider if you're looking for more stable, sustainable growth versus, the swings that Julian is talking about.
And to your point, that's such an important one, because I think for the people who, again, overcomplicate what investing is, right? I have to be an expert in that. I can't just watch the news. I've got to watch CNBC, and I've got to, plug into all these other things, and I've got to get there. And it's like, you actually don't. You could just watch the same regular news, watch that 2 minutes and get a quick 30-minute or 30-second pulse check of what's happening, or just swipe on your phone, right? And you can see what's going on. And it's a really simple and powerful way of staying updated on everything that's going on. The last part that we want to talk about are financial statements. And in this section of the annual report, they break down things like income statements and balance sheets and other highlights that give shareholders an in-depth perspective of how the fund is being managed. Again, if this were a company, we'd be looking for things like profitability, positive and growing cash flow. And in these reports, it's not that much different. But I'll be honest, it's something that's probably better suited for someone who has a trained eye on reviewing these financial statements. I can do this to a small degree. And so with that said, here are some of the key takeaways from my untrained eye and perspective. And I'm rounding up because these are some ridiculously big numbers. But total assets in this fund, 1 trillion. Let's just say 1.4 trillion, because there's 9 other numbers after that.
Trillion is just an impossible number.
A giant number. And I don't feel like stumbling over it, could go from trillions to billions and thousands. 1.4 trillion. But what I think is really interesting is that the total liabilities are, let's just call it $5.5 million. Right? So when you think about the general health of the fund, going back to how little they charge, right? What other sort of bills that need to be paid for. Like, this is not a fund that is at risk of defaulting on anything anytime soon. Like, it might as well just say zero, right? Like, it's a rounding error.
There's a reason why they're holding $5.5 million of liabilities.
Yeah. It's
probably a smart one.
Yeah, it's pennies. I will also note that it says that these numbers are expressed in thousands, and so it's kind of weird. Like, I was like, I don't know what even comes after trillion, but it's a lot. The point is, assets relative to liabilities is very favorable, and conveys a very healthy and well-managed fund with very little risk of defaulting on anything. So there's no or should be very little concern for you as an investor.
Yeah.
Another statement I looked at was the income statement. And the total income of the fund in 2021 was $16.7 billion. Again, relative to the expenses, just as if this were a company, $16.7 billion of income, $527 million in terms of expenses. That's what it costs to actually manage this fund. And again, that's laughable, right? I know that sounds like a big number, but relative to what they brought in, that is like change in the couch, right? So that's how much it costs. Another way of looking at it is this way, so it might be a little easier. For every dollar spent on managing the fund, Vanguard brought in $32, right?
So they earn $32.
They earn $32 for every dollar that they spend managing the fund, right? So it's very, imagine this is Shark Tank.
Or a slot machine.
Right? You put one in,
you get 32 back.
One in, 32 back, and it just keeps going and going and going. So, I thought that was really interesting. Even if you're not comfortable with these kinds of numbers or managing, or understanding financial statements, like that's, I think, a really quick and simple way of looking at what's going on inside this fund.
Yeah, and at the end of the day, we're excited about $32 for one, but there will always be flashier firms promising bigger results, $50 for every dollar, $75 for every dollar. But hopefully this episode gives you enough ammo to look beyond those top line promises and start to learn how they're profiting from getting you to believe the same things that they believe in. You can look at how they're investing your money, what bets they're making, and how much they're taking from your initial dollar to understand what you're going to be left holding at the end of the day.
Yeah, and by the way, like, you're going to pay them whether or not they get it right or wrong.
Correct.
Right, which is the part that for me, I was like, no thanks.
Yeah, they might promise you
I'm not paying you a premium to try.
Yeah.
It doesn't matter, right? Because after a while, psychologically, like, there's very little, motivation for you to try to accomplish your objectives because you're getting paid anyway. So, anyway, this has been fun, very nerdy. I hope someone's that's listening, I hope some light bulbs went off in your head. Why don't we move on to closing thoughts?
Yes. So my final thought is, if you're a person who's struggling with feeling confident as an investor, reading a fund's annual report is a great place to start. And this isn't secret information. In most cases, you can Google it or read articles from Wall Street analysts and get their reactions. You have access to this information, again, in most cases, whether you have $1 invested or not. It's something that you can do and read as kind of homework. Look at the performance summaries, determine what bets they're making, how much they're charging, and then decide if you agree. If you don't, but you've already invested, maybe through your employer-sponsored 401k, then move your money and find a fund that you align with the click of a button, right? The first time I moved my money out of an aggressive growth fund and into a lower cost index fund, because it was more aligned to my worldview, did wonders for my confidence. And so my hope is that it does the same thing for you.
Okay, my closing thoughts are, after 10 years, I'm willing to say on record that, like, becoming an index fund investor and choosing to take this, doesn't seem so unusual now. At the time, it felt unusual. It was without question one of the single best decisions I've ever made in my life financially. It freed me from my own expectations of feeling as if I needed to be an expert in all things, to be a good investor, and it empowered me to like keep things simple and to really believe in that as a way to build wealth. And doing that is what allowed me to pour my energy into other areas of my life. So whenever people ask me for advice on like making the transition from work to being an entrepreneur, I always tell them, actually a big part of it was like choosing to live well below my means and becoming debt free. Like that made making the leap that much more comfortable. And even now when people ask me, wow, like you guys are crushing it as entrepreneurs, like how do you do it? And they're looking for a secret, like an agent or a coach or something like that. It's like, actually, it's because I know I can afford to fail, right? We've been investing for 10 years. Like I can afford to get this wrong and it's no real sweat off my back. And so you approach your work differently. You're much more willing to take on creative risks and to stick to your guns rather than having to pick up and fight for every single dollar. And so hopefully, those ideas and our simple breakdown of this report kind of help you think about more than just making money, but like how it impacts how you show up as a partner, as a parent, as an entrepreneur, if that's something that you aspire to. And even if you don't, how you approach work, because all of those things are connected.
Ooh, well, ain't that the truth?
That is the truth. Amen.
Thank you for listening to another episode of the Rich and Regular podcast presented by Success. I hope we've done wonders for your confidence levels, but if you want to return the favor and do wonders for my confidence level, help us get to 100 reviews on the Apple Podcasts ratings and review page. We will see you next week.